attractions of a pension is the tax relief you get on the money paid in. This boost can make a big difference to the amount your pension is worth when you come to take money out in retirement. But how does it work? The answer depends on who's paying the money in, you, your employer, or someone else. Let's look at money you pay into your own pension first. When you make a payment, known as a contribution, into your SIPP, it's paid net of basic rate tax. This means that if you want to save £1,000 in your SIPP, you only need to pay in £800 of your own money. That's because if you've been paid £1,000 in salary, basic rate tax deducts 20%, meaning you only receive £800 in your bank account. When you pay this £800 into your SIPP, HMRC give you that £200 back. As your pension provider, we automatically claim this basic 20% tax relief for you, which is paid directly into your SIPP under a system known as Relief at Source. Relief at Source is claimed monthly, and the money will appear in your SIPP account ready for you to invest within 7 to 11 weeks. One important point to remember, you can only make personal contributions up to 100% of your earnings for the tax year. This is the gross figure. So if you have earnings of £40,000 and want to make the maximum personal contribution, you would actually pay in £32,000 and we would claim £8,000 to top up your SIPP. If you have no earnings, you can still pay in £2,880 a year and this will be topped up to £3,600. If you pay a higher rate of tax, i.e. higher or additional rate, or intermediate rate in Scotland, you're eligible for a higher rate of tax relief. To claim this extra tax relief on the money you've paid into your SIPP, you need to complete a self-assessment at the end of the tax year. In the tax relief section of the assessment, you should enter the gross amount of your contributions. So if you paid in £800 and received £200 tax relief in your pension, you should enter £1,000. HMRC will then adjust your tax for the year accordingly, giving you the extra relief. If you don't usually complete a self-assessment with HMRC, you can register with them online so you can complete one. Alternatively, you can phone or write to the tax office to claim back the extra tax you've paid. Contact details are given at the end of this video. Just remember that you'll need your national insurance number when you contact HMRC. Next, let's look at pension contributions by your employer. If your employer makes a contribution to your pension scheme, then you get the benefit of that extra money in your pot, but your employer gets the tax relief. This can be a very efficient way for an employer to pay you, as contributions to pensions reduce the company's profits that are subject to corporation tax. This is the same as paying salary, but with the addition that the company doesn't have to pay national insurance contributions. Some employers may pass on this extra benefit by paying even more into your pension. Unlike personal contributions, employer contributions aren't restricted by your earnings. Lastly, to contributions paid by someone else. If you're fortunate enough to have someone other than your employer paying into your pension, it's treated the same as if you made the contribution. So, basic rate tax relief will be claimed in your SIPP, and if you're a higher rate taxpayer, you should still claim the extra tax relief as if you'd contributed it all yourself. All these contributions, whether they're made by you, your employer or anyone else, are added together each tax year and tested against your available annual allowance. If you exceed your annual allowance, you'll face an annual allowance charge.